As a beginner trader, if you don't know which time frames to use or what each time frame should be showing you before you enter a trade, you will likely never become a profitable trader. I'm going to show you my top-down analysis, which is insanely simple and repeatable and will increase your win rate as well as reducing the amount of time you spend at the charts. So I took this trade as a follow along, and this one I stayed in, and our daily higher time frame structural swing point, which is the target, soon gets absolutely smashed. So let's jump into the chart where I have the German DAX or the German 30 on the charts. Now I do like to trade a trending market, which US and European indices and commodities such as gold tend to be. Now, from a higher time frame trend, what I mean by that is a daily or a weekly trend. So higher highs and higher lows. And I'm going to run through a really simple way of identifying what a trending market is. We're also going to be covering 3 major time frames today and another time frame for a refinement on entry. The top time frame, the highest time frame, is going to be the daily, which is where we're at now. This is where we're going to be identifying our daily swing highs and lows to identify a trend, which can determine whether we are in a bullish market or a bearish market. The second time frame is going to be the 4-hour chart. Now this is giving us more of an intraday bias, which we want to align with the daily time frame. So if the daily time frame is printing higher highs and higher lows and is therefore a bullish market, we want to wait for the 4-hour to also be printing higher highs and higher lows for this high probability A+ setup to play out. And that is the 2 time frames to build that higher time frame bias before we move to the 15-minute or 5-minute, which are our entry time frames, which, guess what? We want the same thing to happen again. So once the daily's bullish, the 4-hour is in alignment with the daily and it's bullish also. We then want the 15-minute and the 5-minute to also be bullish before we enter the market. And there's a few other variables like profit targets and entry model that I'm going to be teaching you towards the end of this video as well. So stick around for that. And by the way, this is very, very simple, very, very beginner friendly. So let's begin with identifying on the daily time frame, which is the higher time frame we're going to be looking at, the highs and lows. So we can easily identify these swing points. By swing, I don't mean every single wick and high and low in between, but when it breaks a structural high, that's the swing. When it breaks again, we have a new swing low. We wait for it to pull back, we have another swing high, wait for it to break that, it creates a swing low, and again, we have a swing high when it breaks down below. So we can keep looking at this, and I'll keep drawing this on, I'll make it clearer later on. So we have another swing high, breaks the high, another swing low, until we get to another break, where we are at now. Now I've used bar replay because I've gone back a few months to show you a really, really high probability trade, and I will show you the trade profit because I did take that trade live as well. So when we get to the entry, I'll identify the area that I got involved. But for the purpose of this video, I want to keep it really simple and focus on the important stuff. Like 11 years ago is when I first started learning how to trade. And one of the first things, if not the first thing that I ever was taught, was how to identify a trending higher time frame. So daily 4-hour trend. And it's arguably the most important thing in my trading now, 11 years later. Right, let's get rid of all this. And I want to look at where price is currently on the charts. And we're going to do the same thing, identifying the previous daily swing highs and lows, but I'm just going to draw it on with a box instead, so it's cleaner than the drawings. So we have this high, and this is a previous structure, of course, but it's good to start left and move right. So we're going to identify this range as a daily range because we had this swing high and swing low. Now another element in terms of higher time frame market structure and entry model is liquidity. Now there's so much content out there on liquidity, I can understand how it can get confusing, but let's just keep it really simple. If you are in a bullish market, The only area of liquidity you want to be aware of is when price takes a low, stops moving lower, and you see a reaction on that time frame. Your expectation in a trending market is that that highest level is going to be the next target, and you will trade into this until it gets there. So this is the level of liquidity that you'd be looking at. Now that is from a daily perspective, a 4-hour perspective. It would also be the entry model that I'm going to show you. So it's the same on all time frames. So let's keep the liquidity model very simple. So what do we have here? We have a swing high, we have a swing low, we have a dealing range. So just use a box and mark it on the high and the low and drag it across. And you won't always get a run on liquidity, but we have one here. See, it reacts, stops, doesn't push any lower. We get our recovery to the back inside that range. And where are we expecting price to target? The structural high, which you can see it takes. What price does next is it creates a new daily dealing range. So we have it here. Price, instead of taking liquidity on the daily, because we've only just taken liquidity on that time frame, it's unlikely to take it again for, let's say, a few weeks, maybe even a few months on the daily time frame, but it just basically pulls back into the support area, which is the previous daily range, and then it breaks structure again. So we get another break of structure and another swing high. So what we do in that case is we move our daily swing range higher. What does price do? It pulls back. It doesn't take daily liquidity. It does take lower time frame, but we don't need to look at that. And it breaks the high again, breaks another daily structural swing high. So what happens then? We get a new daily low and daily swing high, which gives us a new dealing range. So let's just make sure these are all marked as daily. And we'll just drag this over. So the further along we go in price, the more weeks and months that go by on a daily time frame, the more chances are that that time frame is going to want to take liquidity. Now remember, keep it really simple. We've got higher highs, higher lows. We'll get a consolidation inside a dealing range before price takes liquidity and then breaks structure. It will then continue if it's a trending market, which is again why we trade indices and commodities. And the further along we go, the more chances that price on that time frame again is going to want to take liquidity. After it's done that, where is your target? Your target is the higher time frame structural high again. So your first initial target was here. Your run on liquidity was here. And it breaks structure. We wait, we're obviously continuing on a 4-hour time frame. It takes a whole day for a daily candle to print. So this is months of data here, but then the same thing happens. So the next consolidation takes liquidity. There's the sweep of liquidity. We'd be looking at getting involved in buys, and the target would be the higher time frame structural high. And that's exactly what we're looking at here. We'll be doing the same on the 4-hour time frame and the same on the 15-minute time frame. So we are expecting this low, this dealing range low, to be swept at some point. I'm just going to remove this one so it becomes clearer and we don't need to look at these anymore. In fact, I'll remove all of these. Let's keep it really, really straightforward. So I'm just going to play this forward because this was internal consolidation on the 4-hour time frame, which I will run through. We're still on the daily time frame here, right? Let's not get ahead of ourselves. I've been teaching traders for perhaps 3.5, nearly 4 years now professionally. And the biggest thing that I find traders get stuck on, and they do it to themselves, is they spend too much time on a lower time frame. They spend very little time on a higher time frame, like the daily and the 4-hour, and they spend way too much time on the 15, 5-minute, and even the 1 minute and lower. And they wonder why they're taking 7 losses a day when they should be taking 2 to 3 trades a week. And their strike rate is like 15, 20% when it should be more like 40 to 60%. And they're spending all day looking at the charts when they should be spending 30 to 60 minutes looking at a chart and setting alerts and doing other things, right? So this video is going to really tone that down and help with overtrading. So what do we get here? Price has taken the daily low. Not only has it done that, but the nature of price is that it's closed with a wick. So it's showing again a slowdown in price, just like we had this bottom wick down here. So our job is now done on the daily time frame. We've come from previous price, we've identified as a trending market, we've had a run on liquidity quite a while ago. In fact, it was over 100 days ago. So we're looking 3 months, and it's about time we got another one. So we've had a run on liquidity inside a daily bullish swing range, and we have now a target, which is the highs. Let's go down to our second time frame, which is the 4 hour. So for the daily consolidation, which is basically price moving sideways and accumulating price on that time frame, the lower time frame down from the daily is the 4 hour, which means the 4 hour will be in a pullback phase. So if the daily's bullish, the 4 hour will be bearish, and we can identify that very easily because we can see after price broke this low here, what price started to do on that time frame is it started to create lower lows and lower highs until it ran into this daily low. Now what we want on this time frame is we want it to shift bullish. We want a market structure shift bullish. Now, just like I was explaining about liquidity, don't overcomplicate things. Just because it's called liquidity or just because it's called a market structure shift doesn't mean you have to overcomplicate it. All it is alignment with the higher time frame. So if the higher time frame is printing higher highs and higher lows, that's what you want to wait for on the 4 hour time frame. So let's play this forwards, because identifying the most immediate 4 hour range is still bearish. And we're going to do the same thing I did on the daily, which I'm just going to remove now because we've got a high and a low. This is now a 4 hour dealing range, the same exact thing we did on the daily. But you can see it's got a lower low and a lower high, so we're still bearish at this point. So we need price to push down, ideally create a smaller 4 hour range, something like this, and we'll tidy it up shortly. So if price comes down, creates a new lower high and a new lower low, then we want price to shift and create a higher high, ideally a second higher high, which creates a higher low. And then we're going to drop down to our entry time frame inside of here. And this is the golden zone, which is what I call for that A plus setup. It's in this area, which is specifically after a daily and 4 hour consolidation in a daily and or 4 hour bullish market, a trending bullish market, because indices tend to be bullish more than anything. Ideally after a daily run on liquidity, but doesn't have to be, but absolutely after a 4 hour run on liquidity, which you can see would happen inside of here anyway. And after a 4 hour market structure shift to the upside. And then the last element before dropping down to the 15-minute is what we'll cover next, which is either a run on 4 hour liquidity and a 15-minute shift inside of here, or without the run on liquidity and a 15-minute shift. And we will cover that and we'll go right down to entry model. But for now, the 4 hour is not showing what we need before jumping down to the next lower time frame. So if this is on my watch list in my Traders Accelerator, and I'm giving my daily morning outlooks to my mentees, my students, which I do every single day before London and before New York, I would say I'm waiting for more development. Of course, there are other techniques and other strategies like counter trends, 4 hour expectational flow. I would sell into these areas, but this is more beginner friendly. This is more AA plus. This is more high probability. This is trading less and only trading with the trend. So we're waiting for more development. So we wait for price to push lower, and you can see what it does. It wicks that 4 hour range. So we can now take a new 4 hour dealing range on the low and on the highest point here. And this becomes our new 4 hour dealing range. We can remove that one. Still bearish though, right? Lower low, lower high. But we're still at that daily level. Just because it wicked below that 4 hour low doesn't mean anything's changed. Also the nature of price, another wick, another reaction instantly to this area. So what we want next is this 4 hour dealing range high to be breached, and then for price to pull back, and then we'll be looking for golden zone to buy, and this higher time frame structural swing point is our target. So let's play price forwards. And again, yes, this is bar replay on TradingView, but I did actually take this trade live. I'll show you the screenshot when we get there. So we've broken a new high. Now, here's the thing. When you get market structure shift, there's a couple of different scenarios. You've got one break here to the upside. So you could be saying, well, what if that's a run on liquidity? Because you've got lower lows, lower highs. Price comes back to take 4-hour liquidity. What if this rolls over to the downside? Right? Well, first of all, you've got the daily on your side. Daily is bullish. Daily ran into liquidity. Nature of price here is wicking. So actually wick 3 times into that daily low if we extend this line. And also in terms of a 4-hour market structure shift, typically for confirmation, I'd want 2 higher highs and 1 higher low. But at a daily level of liquidity, which this has run into multiple times, I am happy with 1 break to the upside, which is exactly the same that I teach on a 15-minute. If the 15-minute is bearish and the 4-hour is bullish and I want a 15-minute market structure shift to the upside, if we've run into a 4-hour level of liquidity, I will be looking for buys after 1 single break of the high on the 15-minute. But if we've not had liquidity, I will typically wait for 2 higher highs as confirmation. So what we're waiting for now is price to pull back into this area, generate liquidity, so a low. So we could have this area here. I'm just going to mark as a 4-hour level of liquidity. And if price pulls back into that, then that's even higher probability for us to look at our 15-minute time frame for opportunities. But we haven't even covered the 15-minute yet and what we're looking for on the 15-minute chart. So we are waiting. Here we go. We get a run in on that 4-hour low. And by the way, this is all predetermined. Of course, I'm not always right. No one ever is. But if you can have a repeatable system in a trending market which offers predictability, you can have this happen time and time again. And if you only trade this, you'll spend very little time at the charts and you'll maintain a higher strike rate, say 50% and beyond. And you'll be profitable every single quarter, every single month, if not. So we've now got confirmation that 4-hour is bullish. We've got a 4-hour low and a 4-hour high. Our new dealing range is bullish. We only need 1 breach to the upside because we've come out of a daily low. And inside of this, we've had what we prefer. We won't always get that 4-hour run on liquidity, but we've had it. What price could have done is it could have continued higher. It tends to happen when we have fundamental aspects like NFP, CPI, inflation rates that'll just tank to the upside. We also had it very recently around the elections when Trump was announced the next successor in the US elections. Price just tanked, and we had this very same scenario. I was waiting for the golden zone setup, but it was the election week and prices tanked to the upside without even giving us an opportunity. So that tends not to happen when there's high amounts of volume and volatility in the market, but in normal conditions is when you tend to get it. So we've had a break to the upside, which I'll just mark with another line here, and we've had a pullback into a low. Price has taken off, come back into that 4-hour level of liquidity. And again, look at this nature of price, not making this up. It's the same thing as the daily here. Nature of price is wicking multiple times, showing no interest and no commitment to the downside. So we've not only got trend confirmation, we've got time frame alignment, we've got liquidity concepts as well. We've had market structure shift. Now the icing on the cake is now where we could drop down to our entry model, which is going to be on either the 15-minute or the 5-minute. Now, what's the difference between the two? The 15-minute is more confirmation because it's a higher time frame than the 5, so you've let it develop more, and you're going to have more of a higher strike rate, more success rate on that higher 15-minute time frame than you will on the 5. But the 5-minute I will drop down to when I want to get involved in a position. I have my technical analysis, my top-down analysis is on point, and it's exactly playing out to a T how I wanted it, how I predicted it way in advance, hours or days, sometimes weeks. And if there's high amounts of volatility in the market, or if I'm coming towards the end of a trading session, aka London session or New York session, and I believe I'm not going to get a run on 15-minute liquidity to get into that move, I will drop down to a lower time frame because you'll have more runs on liquidity on a lower time frame to get involved. So it comes with slight increased risk, but you get increased reward as well. So that's the time that I drop down beyond a 15-minute time frame. But let's go down to a 15-minute time frame now I wanted to take my time with this video, guys, to make sure you're following this along. But if you ever need to pause and rewind and watch bits back, you go and do that. Be my guest. Now, the trade that I actually took here was what I identify as a risk entry model, which means if the daily and the 4 hour are both in alignment and price on the 4 hour has taken liquidity inside a trading session, otherwise known as a kill zone, and it gives me a 15-minute candle entry model, which is a retrace candle. So in a bullish market, I want a green bullish candle to close. I will take the entry regardless of whether the 15-minute is in alignment with the 4 hour. And what we can see here on the 15-minute quite clearly is it's creating lower lows and lower highs. So the 4 hour is bullish. The daily's bullish, the 15-minute is bearish. So a risk entry model is only allowable at a 4 hour level of liquidity, which we had here. Now we had a secondary run in on this, and there was two opportunities here. Full transparency, that first one was a loss. I took this trade here with around a 70-point stop, straight off that 4 hour low. You see that retrace candle inside, this is London session, took the loss, right? But I didn't let that put me off, because quite often you get secondary runs in on liquidity on the 15-minute time frame at 4 hour levels. Let me just go back to the 4 hour to show you something. It also happens on the 4 hour at daily levels. See a 4 hour low, secondary run in on the 4 hour low at a daily level. Same thing on a different time frame. That's where we run the risk. That's why it's called a risk entry model. So I took this trade as a follow along, and this one I stayed in. I actually had profit target beyond the highs. I'll show you the screenshot on the screen as well to show that I did take this trade. So that obviously absorbed the 1% loss that I took on the previous candle, and about 30 to 45 minutes later I'm back in the same exact trade. And if I just make this visible on all time frames and go back to the 4 hour, this is exactly what I mean by a golden zone setup. In fact, you can see where my profit target was, beyond the 4 hour high into the daily higher time frame swing structural high, which was our target from the very beginning of the top down analysis, right? And that's giving almost a 6-to-1 right there. What I want to show you is a confirmation entry. So if I'm just going to move this to alongside, in fact, I'm going to remove this because I want this to be really, really simple. If you're not quite confident yet in taking risk entries, and by the way, you could take them on a reduced risk. So you could take it on like a 0.5% risk model, and then continuation trades, which you have that confirmation that 15-minute is bullish, which we'll show you next. Those are the trades that you have 3 time frames all in alignment, and therefore you could take at your usual 1% risk. So that's good risk management strategy right there. So 15-minute range, we have a high and a low here. I'm going to use this GAN box. So what do we want? We want the same thing that we had on the 4 hour inside a daily range. We want the same thing to happen on the 15-minute inside the 4 hour range. So we want it to create a higher high, consolidate, and either give a 15-minute liquidity-based entry model, or if the volume is high and we want to get involved, we drop down to a 5-minute and we look for buys targeting that same daily level. So let's play this forward and see what we get. So we're between London and New York session here. So we're waiting for New York session to kick in. And what we get here. So if I'm looking at this and New York session is literally like an hour, 60 minutes, it's going to take probably 2 to 3 hours for a 15-minute to create a new higher high, come all the way back to sweep the low, and then give a retrace candle for me to get involved. This is exactly the main reason why I would drop down to a 5-minute time frame, because you might be right in direction, you might be really high in confidence, you've done a full top-down analysis, your daily, your 4 hour, and your 15-minute are all saying yes, take the trade. But if your trading entry model is off of liquidity like mine is, you are going to miss out and just watch that trade move without you. So let's drop down to a 5-minute, and this is where we'll look at a 5-minute refinement. By the way, 15-minute has shifted bullish now because we broke out of this high. So we've got a higher high, potentially a higher low, and we'll be moving into a higher high. Remember what I said earlier, if we go back to the 15-minute, We only need one break to the upside to confirm a 15-minute market structural shift at a 4-hour level of liquidity. If this area of liquidity was not there, I would want 2 higher highs in the 15-minute. Same thing that I discussed with you on the 4-hour at the daily lows. That's why it's repeatable. So we did have this run on liquidity inside of here. This was slightly before a New York official open, like 2:30 British Standard Time, but it was slightly early. So you could either take that, which is an absolute technically valid entry model around 50 points, and then your target would be way up here at the daily highs. But as kill zone has started inside of here, and we're on that 5-minute time frame, we're going to have to wait for a secondary entry model. So we do have some liquidity inside of here, these 5-minute lows. Let's see if it tags into this. We've already got a risk entry model. So we've got the run in and we've got that retrace candle. That's ideal. So it's inside New York session after New York has opened, which tends to give that drive, that volume. We also have an area of protection for our stop loss, which is that previous low. So 70-point stop. Let's make this visible on all time frames. See if this plays out. Obviously it tags us in. We want to see it drive away, and then we'll jump up a few time frames. There we go. We can see that price is driving away from that area now. Let's go up to the 15-minute and place our take profit at the same area that I took profit on that risk entry, which I'll just place back on the charts now. I had an 80-point stop on this one. Drag this one in. But this is the one that we really want to be looking at. Let's just jump up to the 4-hour. And we'll watch this play out. So do we get a new 4-hour high? Yes, we do. You see this 4-hour dealing range. We now have another 4-hour dealing range, which is here. And our daily higher time frame structural swing point, which is the target, soon gets absolutely smashed. Now you're probably asking me, what is this golden zone and how can I learn it? Well, this is my A+ trading strategy where I teach my students in my, essentially my inner circle, one-on-one. There's no groups involved in this. And I teach my traders exact strategies based on their schedule and their lifestyle. My job is to turn inconsistent traders into profitable traders, and some of my students are making anywhere between $1,200 a week to $20,000 a month. If you are interested in learning more about the Traders Accelerator program, there is a link in the description below. You can click on that and find out more details. I do appreciate you watching till the very end of the video. I hope you took value, and I will see you on the next one.